We're at MIPIM 2024 and we are joined on the set of BITV by Mr. Christopher Mertlitz, who is Head of European Investments at WP Carey. Christopher Mertlitz, thank you for joining us on the set of BITV.
Thank you very much for having me. It's a pleasure.
It's an interesting time to be at MIPIM this year because after 18 months of brutal rate hikes, there seems to be a little bit of stabilization in the macroeconomic environment at the moment. Most analysts even suggest that rate cuts could be on the horizon. Some talk April, other later in the year. Depends if you're optimistic or not, I guess. What assessment do you make of the European commercial real estate market at the moment, given that we seem to be entering in a new phase on the macroeconomic front?
The way I look at it is that we have really now, and you mentioned the 18 months. I think it's close almost to 2 years. We've been going through this phase of transitioning phase really towards a new and higher interest rate paradigm. And that period has been exceptionally difficult for a lot of real estate investors because that's uncertainty. And one key thing in uncertain times, it's very difficult to price transactions. And so that led also to a material reduction in transaction volume. So I think as we leave this phase, as we enter a newer normal of higher rates, I think that newfound level of stability will bring back transaction volume. And that not only because of the stability, but also because there's certainly some pent-up demand in transactions as well. So I think as we have this new phase, that's certainly something that will allow for more transaction activity, more transaction flow, which is good for the industry as a whole. But I would just remind people that specifically in the niche single-tenant sale and leaseback sector that we look at, I mean, base rates, that's one component of the cost of capital. But certainly for corporates who are our core target audience really in these projects, also the spreads of their cost of borrowing on top of the base rates, that also changed dramatically. And so overall, as we see a new environment with higher rates characterized by certainly a market where there's less availability of cheap capital, I think for us in really our narrow focus on sale and leasebacks, I think actually we're quite hopeful that this will lead to an increase in volume and we'll see more deals. So I'm quite optimistic for this environment that we're in right now.
Okay. Optimism is great, but there are still a lot of challenges on the market at the moment. What do you see maybe as the biggest challenges that real estate investors have to manage, or I don't know if overcome is the right word, but to work with in this new environment that we just discussed?
I think it's a good question, but I think it depends a bit on who you ask and what type of company you're dealing with. I think if you'd say main challenges, then a lot of the traditional incumbent funds out there, I think they are struggling with these changes in the valuations, specifically companies who really benchmark themselves relative to their own NAV. I think they're still struggling a lot because their the valuation piece in the NAV, that depends on valuations, and valuations require comparables. And if you're in an environment where you have very little transaction evidence, you really struggle with that. And they almost, in some instances, there's companies in Europe that are, I would say, they're basically stuck because they're trading at quite a big discount to their NAV, according to whatever they define the V to be. And that means that they find it difficult to raise new equity, they find it difficult to invest. So I think those companies are very much stuck in with that, and that's a very difficult environment to be in. I'd say others who maybe are more, leveraged buyers, who maybe don't have the NAV issue, I think they are still struggling in this environment with the availability of debt financing on attractive terms. And you blend in with that, and where do we stand? Well, we have a very unique position here as being an all-equity purchaser, so we don't have to deal with that. And we're really a spreads-based investor. So we really care about our investment spreads relative to our cost of borrowing. So thankfully, there's challenges for everyone, including ourselves. But I think challenges are there to be overcome.
Yeah. You mentioned WP Carey's sell and leaseback strategy. Obviously, in a new environment, there comes new opportunities, new challenges. what are the priorities to roll out that strategy in Europe in general, in France in particular, and how does that strategy maybe evolve given this new market environment?
I'd say one of the hallmarks of our approach is really the fact that we've been doing this particular type of transaction for 5+ decades now. And it's funny when it's every year, beginning of the year, people ask me, what's new? What's the new strategy for this year? It's like, well, same as last year.
Yeah.
It's all about providing really that long-term inflation-protected, secure income. That's really what we do for our investors. And that hasn't changed in the last 50 years, really. And I hope it won't change for the next 50 either, because it's a very resilient business model that works well through investment cycles, and that really, well, it's just fundamentally a very sound business model. So, yeah, I think, here's to the next 50, and I don't think that much has changed from our underwriting. It's the same focus on good companies, solvent companies, and from a credit underwriting perspective that we're very comfortable with.
But maybe the question then becomes, are there more opportunities coming out of macroeconomic turmoil with a lot of companies? Maybe I'm thinking about different retail portfolios that made the news being exchanged across Europe over the last year. Do you see maybe renewed opportunities for such a strategy in this market environment?
Yes, and I would say mildly that what we do is anti-cyclical. So that when you see a softening in the macroeconomic environment, that maybe more companies would consider a sale and leaseback as a way to raise capital, to pay down debt, to maybe buy a competing business, to invest in whatever the corporate wants to invest in, really. So there is a degree of mild anti-cyclicality, but I would shy away from characterizing what we do as something you only do in bad times. It's fundamentally not the case. But I would say overall we see increased transaction momentum. Maybe if I look at one typical type of seller, I would say from private equity companies, that seems to be a very active type of sellers, because they tend to have maybe portfolio companies that are somewhat higher up on the leverage curve, and so they have I'd say more pressure somewhat to reduce debt. And again, that's a really good use of sale and leaseback capital, is to deleverage. And so that's something I'd say where in the current phase of the cycle, we actually see quite a lot of interest, which is good. I mean, that's something we really like and we exceed in actually selling.
All right. Thank you very much, Christopher Mertlitz, for taking the time to speak with us, for this valuable insight. Thank you all also for being with us, and we'll see you soon at MIPIM 24, on the set of BITV.